Let's look at step 6. Imagine making 47 units of risk and gain or 100% in a month. Well, that's happened to two different students I have. 47 AIR was generated in August 2016, and 100% on the account was generated in October 2016. So we've done it, including, as I mentioned, some of my students. So such results are definitely possible, and I'm going to show you today how it is possible to reach these results. The only way to reach them is to generate more frequent opportunities and time those entries on smaller timeframes. And later on, if you stay with me in the analysis of the market, I'm going to show you some of the some example of timing on the larger time frames, but the same concept apply to the smaller time frames. So in my FibStalker Methods coaching program, I teach a proprietary technique called FibStalking to do just that, to time entries. And I'm going to explain very briefly here how that works in a moment. What you can do, you can use this technique with trading signals, swing trades, or with your own price structure analysis. If you perform analysis and identify area of potential support or resistance, which are also area where algos and smart money comes in, then you can you can use the FibStalking timing with technique with that. The way I use it is to identify the presence of algorithms on a smaller time frame so that I can use that to identify confirmation level to enter trades. So what I do, I study the sequence of measured moves, counter trend measured moves on the smaller time frame into an area of support or resistance, and I use the failure of that sequence as an indication to enter the trade. And I'm going to be a little bit more precise in a moment here. It's very easy to use it, and it's step-by-step, it's procedure. So it's a timing technique, which is also a procedural technique, which is not heard very often in traditional technical analysis. It allows risk reductions by waiting for a stronger participation in the direction of the trade. So let's look at how it works. It's very simple. Let's imagine that we are at point D. So there is a trend that has been established here. We went from A to B into C and then again into D, and now it is possible that this market is going to retrace. If this market is going to retrace, you are able with some models to identify the potential area where algorithms could come in. One of the models, for example, it's identifying the 50% between C and D and time the market if and when price gets into the level. So what this timing really means? Well, what we do, we focus on the counter trend move here. We have the trend that is going up, and the counter trend is going, being counter trend is going down. So it's going the direction opposite the trend here. So the counter trend move in this case is the move D to E. So what happens there? Actually, if we believe, and I certainly do, the proof is in price, and if you study my analysis, you will easily be convinced. If you believe that in major markets and high value markets there are algorithms that induce a sequence of measured moves on price, then it's very easy to imagine that in modern markets, these algorithms are also on the smaller time frame. So there is this sequence that we see here, and what we believe is that there are also sequences in the counter trend. So sequences like this. And that's exactly what we do. We focus on the move, counter trend move from D to E, which is what you see here on the screen. And then when price comes into an area that we have identified in advance, so when it's printed, we already know it is E. In fact, we trace, for example, from C to D, and we already know the 50% retrace in this specific model. It's not always 50%. It can be traced in a different way as well. But I want to focus on the concept of timing here for a moment. So we studied the counter trend move D to E, and This counter-trend move on high-volume market shows the presence of agents, of algorithms, of smart money, you can call as you want, and there is a structure that can be identified very much using the same tools that we use to identify this level in the larger time frame. So the point here is that if this is a trend and we anticipate a continuation higher, there has to be a fact or an indication that the sequence here counter trend fails. And the explanation for that is that if there are agents, algorithms, smart money that comes into this area E in order to keep pushing price higher, so to put an end to this counter trend, then this counter trend has somehow to fail, which means that this sequence has to fail, and the technique allows the identification, clear identification of a confirmation level that we use to basically confirm that participation from the larger time frame here that is coming from algos or smart money at E is stronger than the participation of the shorts who want to keep short in this market well below the E point. So it's kind of a balance of power here. There is a larger time frame coming in and a smaller time frame that keeps pushing this price lower in the counter trend move. Of course, for the market to move lower, we need to have people taking profits as well as people establishing on a smaller time frame new position lower. If that keeps happening, this market can also break this area. In that case, the trend, the larger trend, can continue. Okay, so this is the whole idea of timing. Why timing is important is that, as you can see here, it actually moves the focus on the on a smaller time frame. Let's say that this is a daily time frame, and I'll call this time frame T. The lower time frame where I study this sequence is T minus 1. In this case, it could be 4 hour, but could also be a 1 hour time frame. So as you can see here, when I move from a daily to a 1 hour time frame here, yeah, clearly, if we have the possibility to identify confirmation level, we also can work with the smaller pip risk, considering that the market is not going to revisit the low that has been printed. And that's typically the case. Okay, after, but only after we price actually gets above this confirmation level. So that's the way, at least in the way I look at the market, and the reason why it is important is because it allows the reduction of the pip risk here, which actually reduction of pip risk here at point A, above point A, or point X here. So the distance X to E gives us the pip risk or the tick risk. And so we use this to get a confirmation and enter at the same time to control and make our pip or dollar risk as small as possible, which would actually offer us bigger reward to risk, which is what we want actually. Okay. Price structure analysis, on the other hand, is the process that helps us discovering how algos are positioned in all time frames, and this helps us identifying and generating valid trading ideas. The trading ideas are then filtered through trading system, and I'm going to talk briefly about trading system in the next step 7 next week. So to have an idea of how I structured the trading process, which includes the price structure analysis, which is this first box here, this gives you an idea. So we do the analysis on all time frames. The output gives us an initial idea of trading plans. The output also goes as an input to another sub process, which is price discovery. And price discovery is basically While price structure analysis helps us identifying how algos are positioned in all time frames, price discovery helps us understanding what can happen next given that positioning of algorithms. And when we apply price discovery now, we can go from trading plan ideas to validated trading plan ideas that actually take into account what we know about the way the market works, what we know about how smart money is positioned in the market. And when we put all that information together, now we have validated trading plans. We don't trade directly validated trading plan. What we want to do, we want to filter those trading plans to a set of simple trading systems, which filter out the noise or the things that we know not working with a high probability. So it's basically a three-step process, which is basically number one is devising price structure, which means again how smart money and algorithms are positioned in all time frames. With that information, performing price discovery, which actually allows us to understand what is possible to happen, and that gives us validated trading plans. But we only trade in the final trading plans, which are basically the validated plans filtered through our trading system. So that's the way you manage the trading process, and you manage risk as well, because when you apply this process, you're also reducing risk, and you're not doing that directly by reducing your pip risk or lowering your stop or making sure that your stop is not it. You are doing it by applying a process that allows you to identify only low risk, high probability trades, and that's and the quality of the setup is much better because you're following a strict process here. Okay, so this basically concludes the educational on step 6 of our 10 steps to successful trading. What we looked at, we looked at two things: timing setups, how timing setups can help us increase the reward to risk. And the reason why we can increase that is because we get to work on a smaller time frame, and particularly when we use the FibStalker timing technique, we are able to identify confirmation level when price gets above for long or below for shorts. Those levels, that's an indication that the smart money that is coming in this case at this E area, it's stronger than the smart money that is pushing on the smaller time frame, the counter trend move. So timing is very, very key because it allows us to generate higher return. Also in the size of 47 unit of risk in 1 month, 100% of the account, and this has been done actually. The other point and area we discussed is the price structure analysis process, and we also mentioned how this process allows indirectly to reduce risk, because by following a proven process and proven trading systems, we can actually reduce the risk and and we can identify low risk setup which have a high probability of hitting the first target. Thanks for watching.